You are listening to The Vocal Technologist. Spoken tech for your ears.
Robinhood now makes more money from prediction markets than from trading actual stocks.
Wonderful.
That land, I'm the vocal technologist, and we are going to take a proper look at a massive stack of financial developments. The whole goal here is to, nut out this fascinating tension playing out right in front of us. It's this massive collision between wild, speculative human behavior on one side and then the cold, hard infrastructure being built to contain it on the other.
Yeah.
So I brought in the big guns to help pick this apart, so let's get right into the guts of it.
Well, I'm really glad to be here because that tension you just mentioned between what everyday people want to bet their money on and the guardrails the financial system desperately tries to build around them. I mean, that's arguably the defining conflict of the entire decade.
Right, so let's look at Robinhood's Q2 earnings numbers because the data is just, well, it's wild. Event contracts, which is basically just betting on real-world outcomes.
Like who wins an election?
Exactly, or what the Federal Reserve does. That hit $156 million in revenue. That beats their actual equities trading, which was sitting at $129 million, and it completely smashed crypto trading at $100 million.
Wow.
Yeah. Overall transaction revenue was up 44% to $776 million. So if you look at this behavior, people aren't really investing in companies anymore. They're purely speculating on events.
And, I mean, if you think about the psychology behind that, it makes complete sense. Traditional investing requires a tremendous amount of patience.
Heaps of it, yeah.
Right? You buy an S&P 500 index fund, and you just wait 30 years.
Yeah.
An event contract gives you a definitive yes or no answer and a payout by Friday.
Which is what people want.
Exactly. But that massive shift in user behavior is precisely what triggers regulatory whiplash. Because when a platform reaches that kind of sheer scale with event contracts, the regulators are forced to step back and ask a very difficult question, which is, is this a functioning financial market, or have you just built a casino with a better user interface?
Which is exactly the fight happening in New York right now.
Yeah.
The state is suing Kalshi, which is a major prediction market platform, claiming their event contracts are essentially just unlicensed gambling. They are going after them hard. They're seeking a permanent injunction, user restitution, and penalties that could hit a staggering $36 billion.
That's a huge number.
It's absurd. But on the other side of the ring, you've got Kalshi, alongside the Commodity Futures Trading Commission, arguing they are a federally licensed derivative exchange. So, I have to push you on this. Is there actually a functional difference between trading a highly volatile, dodgy tech stock and betting on an election outcome? Or are regulators just splitting hairs because one feels a bit unseemly?
Well, that is the core of the entire legal battle, right?
Okay.
And to understand it, you have to look at the mechanical definition of risk.
Okay.
So in traditional finance, a derivative contract exists to hedge a pre-existing risk. Think about a farmer. If you grow wheat, you face the very real physical risk that wheat prices will drop before harvest. So you buy a futures contract to lock in a price. The financial risk of the price dropping exists regardless of whether the financial contract does.
Right, the crop is in the dirt either way. They are just buying insurance against the weather or the market.
Exactly. But gambling, from a strict regulatory standpoint, creates a risk that simply didn't exist before you made the wager. Right? You have no inherent financial exposure to a horse race until you walk up to the window and put $50 on a horse.
Makes sense.
So the argument Kalshi and the CFTC make is that modern businesses and individuals do have inherent financial exposure to real-world events. If inflation spikes or a new tax policy is passed, your business suffers. Prediction markets, theoretically, allow them to hedge that real-world exposure.
But New York State isn't buying that. They're basically saying, come on, average retail consumers aren't hedging corporate tax liabilities. They're just treating this like Friday night entertainment.
Yeah, and take that one step further. New York is arguing that by packaging these events as tradable contracts, Kalshi is essentially manufacturing risk out of thin air for retail traders.
Right.
It's a massive jurisdictional turf war. You have state gambling oversight completely clashing with federal financial regulation, and whoever wins gets to define the future of retail trading.
That actually makes heaps of sense. It all comes down to the underlying intent of the risk, whether you are transferring an existing danger or just, inventing a new one for a thrill.
Spot on.
And that exact struggle, trying to suss out if we're building a casino or a utility, is the entire defining narrative of the crypto space right now.
It really is. I mean, in crypto, you see this constant, almost desperate push to establish institutional rules and systemic trust. But it is perpetually undermined by the simplest factor, which is human nature.
Yeah, we see that push for legitimacy with the Clarity Act. Mark Andreessen and Chris Dixon are championing this legislation, arguing that America desperately needs federal oversight, anti-fraud protections, and clear boundaries between what constitutes a security and what constitutes a commodity for digital assets.
Right.
Their main argument is that without clear rules of the road, the U.S. just bleeds all this technological innovation to offshore actors who just operate in the shadows.
Exactly.
And on the flip side of that legitimation push, you have Circle securing a limited purpose trust charter from the New York Department of Financial Services for their USDC stablecoin. They aren't trying to blow up the system. They are actively trying to weave themselves into the regulated financial fabric.
Because they realize that mainstream adoption requires institutional guardrails. Circle wants their infrastructure to be predictable, transparent, and legally sound, just like traditional banking rails.
Yeah.
They want major corporations to feel safe parking billions of dollars on their network. But here's the brutal irony of all this engineering.
Oh, here we go.
The infrastructure is only as secure as the human being operating it.
Which is where this whole thing gets a bit ordinary. Amidst all this high-level regulatory maneuvering and state-of-the-art cryptography, we get the story of a former FBI supervisory agent named Patrick Yarrock.
Oh, this story?
Yeah. He was charged with stealing $925,000 in crypto that had been seized in a case tied to Russia. And how did this master heist happen? He didn't hack a mainframe. He literally just found the private keys sitting right inside the FBI's own internal systems and transferred the funds to his personal accounts.
And, for anyone who doesn't spend their days deep in cryptography, it is important to understand what a private key actually is.
Right.
It's not like a banking password where you can call IT and prove your identity to get it reset. A private key is a cryptographic bearer instrument. It's a long string of alphanumeric characters, and whoever possesses that string mathematically owns the asset. There's no central authority to reverse the transaction.
So it's like building a state-of-the-art, impenetrable titanium bank vault, placing it on a secure military base, and then the security guard just pockets the gold bars on his lunch break because someone left the door propped open.
That perfectly illustrates the core vulnerability of decentralized systems. You can pass the Clarity Act, you can acquire all the regulatory trust charters in the world, and you can build mathematically flawless cryptography that would take a supercomputer a million years to crack.
Yeah.
But at the very end of that chain, a human being has to copy and paste a password.
Yeah.
The industry is desperately trying to build systemic, programmable trust precisely because the human endpoints remain so incredibly vulnerable.
They really are.
The architecture has to somehow account for the rogue guard.
But this dynamic of wild hype and speculation slamming headfirst into cold operational reality, that's not just a crypto problem. If you look at artificial intelligence right now, the exact same reality check is happening in real time.
Oh, the AI sector is undergoing a massive, painful maturation process right now. The pure speculative phase is ending.
Just look at Leopold Aschenbrenner's AI hedge fund, Situational Awareness. The fund completely blew up.
Yeah.
They were making highly leveraged bets on AI infrastructure stocks, and at the same time, they were shorting traditional software companies. The foundational assumption was that AI would just instantly eat the software industry. But the market moved sharply against them.
And when you are highly leveraged, a small market movement against your position becomes a catastrophic problem.
Exactly. They were forced to unwind their public stock positions to meet massive margin calls. Citadel actually had to step in and acquire the positions just to clean up the mess.
Wow.
It was a purely speculative play that assumed the future would arrive overnight, and it just hit a brick wall.
Well, contrast that spectacular failure with how established functional companies are actually deploying AI. It's not about placing massive leveraged bets on the future of humanity.
Right.
It's about grinding out percentage points of margin.
Spot on. Look at Chime, the massive digital bank. They're cutting 10% of their workforce, which is roughly 150 jobs. The CEO flat out said that smaller, flatter teams enable faster execution. They aren't trying to sell you a flashy AI chatbot that writes poetry. They're using AI internally to drive operational efficiency and profitability because they need to satisfy the very grounded demands of public markets.
What we are witnessing is the shift from systems of record to outcome-driven AI banking.
Okay, unpack that a bit.
So for decades, a bank's core software was essentially just a giant, highly secure database. It recorded that you had $100, and when you spent $10, it updated the record to $90. It was a system of record. Now the industry is moving toward agentic AI.
Ah, right. And if you are keen on untangling these massive industry shifts with us, make sure you subscribe. But I have to push back here because I'm naturally skeptical of tech branding. Are we just slapping the phrase agentic AI on standard software automation to sound impressive to investors? Or is this genuinely a new mechanism? Like, is this actually autonomous? Because half the time it sounds like founders are just having a lend with these buzzwords to bump their valuation.
It is a totally valid skepticism because the buzzwords are definitely out of control.
Yeah.
But the mechanical difference is real.
Sure.
Standard automation is entirely rules-based. It requires a human to map every variable. If A happens, do B. If C happens, fail and alert a human.
Right, flowcharts.
Exactly. Agentic AI acts as an orchestration layer. Instead of giving it a strict flowchart, you give it a goal, and it figures out the intermediate steps to achieve it.
Can you give me a concrete example of what that actually looks like for a financial firm?
Sure. Take Ellis, for example. They raised $10 million to build an AI-native operating platform specifically for private credit. Private credit is incredibly messy. It involves data from fund administrators, partner banks, 200-page legal documents, sprawling Excel spreadsheets. Ellis uses specialized agents to crawl all those unstructured formats, pull the relevant data, and automate the compliance reporting.
Wow.
Or look at Juniper Square launching a tool called Faye. Faye is an AI agent that performs over 150 different operational checks on fund administrator deliverables.
So it's essentially reading the documents and doing the math.
More than that, it reconciles conflicting figures across different reports and different financial quarters. It isn't just following a simple Ethan rule, it's synthesizing complex, unstructured documents to actively flag errors. Crucially, it still keeps a human in the loop for final approvals.
Right, so it is less about replacing the human entirely and more about giving the human an incredibly fast, highly competent research assistant to handle the mind-numbing busy work.
Yes, and the financial impact of that is huge. It lowers operating costs significantly without losing the human oversight required by regulators. But here's the reality check for companies building these AI agents. You can have the smartest orchestration AI in the world, but if it has to rely on outdated third-party banking rails to actually move the money, it's like putting a Ferrari engine in a horse-drawn carriage. They'd eventually hit a wall if they don't own the underlying infrastructure.
Which brings us to the part nobody is really talking about. The massive, quiet scramble to own the underlying rails of the financial system. Fintechs are realizing that relying on traditional sponsor banks is a massive operational bottleneck. Flex, the rent payment platform, is a brilliant example of this. They let renters split their monthly payments, and they've processed $40 billion for over 3 million users.
That's a lot of volume.
Huge. And they just applied for an industrial loan company charter or an ILC. If they get it, they don't need a sponsor bank anymore. They can issue their own credit products directly, entirely on their own terms.
And that desire for absolute top-to-bottom control is pushing founders to take incredibly drastic measures.
It really is. Dar Buckley, the founder of the Fintech Increase, literally went out and bought an entire Washington community bank.
Wow.
He didn't partner with them. He just bought the whole bank to get direct, unfiltered control of regulated infrastructure. He wants to compete directly with banking-as-a-service providers. It's the exact same logic as retail. It's the difference between renting a shop and buying the whole shopping center. You want the margins, you have to own the concrete.
And the reason we are seeing this aggressive vertical integration is partly because relying on third-party digital integrations is still fraught with friction, particularly in the United States.
Oh, absolutely.
Look at the open banking landscape. In Europe, regulators mandated standardized APIs and instant account-to-account payments years ago.
And for anyone outside of software engineering, an API is basically a secure, dedicated digital pipe that lets two computer systems talk to each other directly without a human logging in.
Exactly. It's clean, it's fast, and it's secure. So in Europe, it is very easy for a new fintech app to plug into your existing bank account securely. But in the U.S., without clear federal mandates, banks are incredibly protective of their data.
Yeah.
They rely on costly, fragile integrations. Many apps still have to rely on a process called screen scraping.
Which is terrifying when you actually realize how it works.
It is. Screen scraping means a software bot literally takes your username and password, logs into your banking webpage pretending to be you, and visually reads the text on the screen to pull your balance.
That's just wild.
It's incredibly inefficient, it breaks every time the bank changes their website design, and it is a massive security risk. Imagine handing a stranger the physical keys to your house just so they can check if your television is still in the living room.
Right.
That is essentially what screen scraping is.
Ah.
Because of this mess, U.S. companies that want to offer seamless experiences are forced to just buy the bank to bypass the headache entirely.
And while the startups are buying community banks, the legacy giants are upgrading their own plumbing to make sure they don't get left behind. Wells Fargo is rolling out tokenized deposits for corporate clients, starting with US dollar to British pound exchanges. They're giving clients the ability to move and settle funds 24/7.
Which is a fundamental shift in how money physically operates.
Yeah.
Historically, international transfers involved batch processing. You request a transfer, and overnight, a series of ledgers at different correspondent banks eventually update to reflect the new balances. A tokenized deposit means the money itself is programmable code.
Right.
It moves and settles on a distributed ledger instantly, regardless of what time it is or what country it is going to.
And to protect all this newly digitized, instantly moving infrastructure, Visa just acquired a company called BioCatch for $2.4 billion.
Now, BioCatch is fascinating because it addresses the exact vulnerability we talked about earlier with the FBI agent and the stolen private keys.
The human endpoints.
The human endpoints. Think about the perimeter of your digital life. For decades, it has been a password, a string of characters, but passwords get leaked and they get guessed.
Right.
Then we moved to two-factor authentication, a code sent to your phone. But hackers figured out SIM swapping. Now we're dealing with AI that can generate a perfect deepfake of your voice in seconds.
Yeah, it's scary.
So how does a massive network like Visa actually know it is you initiating a transfer? BioCatch doesn't care what your password is. They use behavioral biometrics.
How does that actually work in practice? Like, what are they measuring?
Think about how you hold your phone right now. Are you lying in bed, sitting at a desk? The gyroscope inside your device knows the exact physical angle. It knows the microshakes of your hand. It analyzes the specific cadence of your typing, the unique curve of your thumb when you scroll, how long you pause before you hit enter.
Wait, so even if a fraudster in another country steals my password, or an AI generates a perfect deepfake, the system flags the transaction because the attacker navigating the desktop emulator doesn't have my specific physical clumsiness.
Precisely. Fraudsters work quickly. They navigate forms using automated scripts or keyboard shortcuts that a legitimate user, who might pause for 3 seconds to try and remember their own phone number, would never use.
That's crazy.
Visa is spending $2.4 billion because analyzing those physical behavioral signals in real time is the only reliable way left to distinguish a legitimate human user from an AI-enabled fraudster. Your physical behavior is your new perimeter defense.
That is just incredible. And because all this core infrastructure is getting digitized, tokenized, and wrapped in biometric security, it is becoming entirely modular. And when the plumbing is modular, the very definition of what constitutes a financial institution gets completely turned upside down.
The traditional boundaries are completely dissolving. When the infrastructure can be accessed via an API, anyone with an existing audience can suddenly become a bank.
Case in point X, the platform formerly known as Twitter, is rolling out X money to their premium subscribers. They're bundling a 6% APY cash account and a 3% cashback Visa debit card alongside free instant transfers between accounts. And you have to remember, X sits inside the wider SpaceX and Elon Musk corporate entity, which has immense capital backing.
And we should clarify why that 6% APY is so disruptive. Annual percentage yield. Most standard brick-and-mortar savings accounts are giving you a fraction of a percent. Offering a 6% yield actively outpaces inflation.
Right.
It fundamentally changes the math for a consumer deciding where to park their paycheck.
But it's not just the tech billionaires making this play. Ikea is launching home insurance in the UK. They partnered with an Insurtech startup called Urban Jungle to underwrite it.
I saw that.
I have to admit, when I read this, it threw me. I go to Ikea for flat pack furniture, a confusing warehouse layout, and maybe some meatballs. I don't go there to underwrite my house against fire damage. Is this embedded finance model actually working for everyday consumers, or is this just massive unchecked brand overreach?
It might seem like overreach at first glance, but if we connect this to the broader economic reality we've been discussing, it makes perfect sense. In an era where payment rails are interoperable and complex financial products can be spun up in weeks via APIs, the actual checking account or insurance policy is essentially a commodity. The financial product itself isn't special anymore.
Yeah.
What is scarce, and therefore immensely valuable, is consumer trust and daily, habitual touchpoints.
You're saying the product doesn't matter, the distribution channel is everything.
Exactly. IKEA already has your attention at the exact moment you are buying a couch for a brand new apartment. That is the precise psychological moment you need renters or home insurance. Why make you go find a separate broker?
Makes sense.
X has your attention for 2 hours a day while you scroll through your feed. If they can embed a high-yield savings account directly into that existing daily habit, they completely bypass the massive customer acquisition costs that traditional banks spend billions on. The non-financial brands hold the ultimate distribution advantage because they already own the relationship.
Which totally reframes how we should look at this entire shift in the economy. We started this conversation looking at Robinhood's prediction markets and the massive flashy speculation happening on the front end. But as we have poked around the plumbing, the AI orchestration, the race for bank charters, the biometric security, a very different picture emerges.
It really does.
I reckon the real winners of the next decade won't be the companies building the most addictive speculative interfaces. They will be the ones quietly buying up the boring infrastructure, securing the regulatory charters, and building the biometric fraud defenses. You own the concrete, you own the future.
Yeah, absolutely.
But before you go, just think about this. If non-financial brands like IKEA or a social network like X become your primary bank, what happens if you violate their terms of service? If you get banned for a controversial post, do you lose access to your checking account too? Vocal technologists, see you soon.
Spoken Tech for your ears.